This conference will now be recorded.
Hi everyone, it's Patrick Reed from the Adamas Principle. The date is the 30th of December. I thought it was New Year's Eve, but there you go. I'm getting a bit old and I'm losing my memory. New Year's Eve is tomorrow, of course, and we've got a full Asia Open tonight. Well, as full as it is in Asia at 10 p.m. London time. We've got Beat in the house.
Hi,
Hello,
Patrick. I definitely wouldn't be in the house if it's New Year's Eve, but given it's the 30th, I made the effort.
Oh, come on. I see you on the rostrum dancing, with the head banging music.
Yeah, but checking the rates at the same time.
Yeah, exactly. So we've got I just want to we've got our topics obviously, and those of you who have seen my LinkedIn topics, we're going to cover those. But there's a couple of things I just want to sort of say that always remember, if you're trading, always remember to just really cut your size down over thin markets, and Christmas is one of those. And I've been doing this a while, and I got caught a little bit. I had a bit of a painful day the other day, and I posted about it. I'm pretty upfront about it. So just be careful, right? Watch that risk. Just be careful, because it can happen to anyone. It just comes out. We had a brutal reversal, but that's life. That's trading. We'll live on. So we've had a very very big year, and we're not going to sort of do a wrap on the year, but I think some of the stuff we're going to talk about today started in 2018 and I feel, going to be continuing in 2019. And the first topic we've got is QT. I think this is really important. It's causing tremors. It obviously hammered EM because of the deficits being, in dollars. It's causing tremors in DM, and I personally think that, along with vol, which really kicked off in February when the vol complex blew out, together is a poisonous cocktail for equities lower. During the week I left some comments on a Bloomberg piece by James Appy. He's as an asset manager at Aberdeen Assets, and I've been talking to a lot, messaging him a lot. Really top guy, knows his onions, and he's basically saying that QT, right, has an effect on the US, which let's not forget is a largely pristine macro picture. What's it going to do to Europe? He's talking about it's too late, structurally it's too late, but this could be something for the future. In 2019, I don't know, the rate path as well, but that's just, I mean, Europe data is pants. It's totally rubbish, and the US data is pretty good. I mean, it's consolidating at the highs. We're still, we're not surprising. The city surprise index isn't going, off the charts, of course, and CPI's taking a hit because of oil. But and the other thing I want to say is that hasn't really reflected totally priced in yet. Just be warned. But what's going to happen to Europe? So, I mean, I don't know what your thoughts are on this, Beat.
Well, first of all, I think that the pristine picture in the US economy, may not stay that way. As yes, to be honest, they come up from a multi-year very strong recovery, and yes, the data is looking quite well. But in the meantime, I think we have this lagging factor from the rate hikes. We have the lagging factor from what's happening in equities. We have the lagging factor from all the lower GDPs around the world. So, I just can't. Yes, I want to come to Europe second, but I think, we gonna have to really start watching data as Powell tells us to do, just to see that maybe that data or the surprise index suddenly starts to turn downwards. I just cannot see the US remaining at that elevated level with what the rest in the world is going on. If a government shutdown in the US usually gets solved, at some point in time, but Trump is digging in for the time being. The impact of the trade war is still to be felt. And we haven't solved it yet. Today was some bullish news again on that front, where Trump said the Chinese work on it, blah blah blah. Has yet to be seen. I still think some stuff might happen, but there's still some really really big fundamental divisions. Into Europe, I think we briefly talked about it offline. So we have a very strong turndown. There's even questions that Germany is in a technical recession in the fourth quarter. They don't react to this just yet, as they feel there's some one-off factors which push European grow lower, all these new diesel emissions, as some stuff in the car industry. So they want to pinpoint in on some single factors that help dragging down growth in Europe. But the data, as we both agree, isn't impressive. And here comes the deal. So we're going to have Q1. It's all about Brexit, which we both don't know the answer. No one does. But clearly a risk event for Europe, which will shape Europe and the ECB and the outlook dramatically. Again, there's two roads, yes or no. Obviously, if you get a no-deal Brexit, then, there'd be no rate hikes in 2019 by the ECB. There'd be even a question mark around rate hikes in 2020, but that's a bit further out. So we have definitely big risk there. We have a risk that we mentioned last chat we had last week, France. You're going to keep an eye on France, how this whole situation continues in France. They're definitely staying on the street, and once Christmas and New Year period is out of the way, be interesting to see if the momentum gathers again and more people join and demand the resignation of Macron. We have parliament election in May. I know I go further out in 2019, but it's maybe the right sort of day to look a little bit into next year. So Europe has a lot of challenges ahead. I think May, the May elections on the European Parliament could be the day of reckoning for Europe, for the people that feel like not really be represented anymore in Brussels. Some countries going to go completely left, other countries will go completely right. So the whole centrist bloc might actually disappear. And we're going to have left extremists and right extremists up in Brussels. So that's going to be a lot of fun going forward. So all in all, like we talked about it briefly offline, I think 2019 is going to be a shocker. I think 2019 is going to see a big mess in equity markets. I think we're going to see, and that globally. And there's not one single reason, as in, you got to watch this or you got to watch that. I think it's the whole mix that we carry over from 2018 into 2019 that just get us pace. I'm very bearish US equities. I just think, you wrote in your notes, what did he say? Will JP blink before the lights go out on risk? To be honest, no, because the only thing that make him blink, which you know my view about the Fed, I'm already thinking that he gave us that dovish signals between the lines. The only thing he will do is pause. And pause will not do the trick. But he's not going to cut rates. He's not going to, there is no Fed put. Right, there is no Fed put. Maybe they try verbally. So I don't know. If the adjustment in the US equity market becomes disorderly. But you pointed just out, you have QT, which will increase dramatically in 2019. The fiscal injection is fading out. The tax cuts effect is fading out. So the US is going to be hit with a perfect storm in terms of the kind of tightening, whether it's fiscal tightening or, QT or, the effects of how many times did they hike rates? 8 times now, I think, since we started hiking rates. So all this together with trade war, we have to wait and see, we don't know. Brexit. I still think it can be a global event if it turns nasty. We don't know yet whether it will turn nasty or not. But that's not just a UK issue, which people maybe forget. It's not, this is not just UK down the toilet or not down the toilet. Brexit can be a drag on Europe, a big drag on Europe. They're already crying about the deficit. So if the UK would walk away with no deal Brexit, which means they're not going to pay the 39 billion pounds to the EU Commission, the EU Commission is already scrambling now for the European budget, right? It's like huge holes in it, and so on and so forth. So I just, that's the one sector where I think equities have just gone too high, in my opinion. We have now, and you know what? The whole or most of 2018, the market ignored the rate hikes by the Fed, ignored the balance sheet stuff from the Fed. Usually what you would expect, we had the equity rally based on QE and rate cuts. And usually when rate hikes start to come, the cycle changes, equities top out and start to grind lower. In this case, equities continue to rally because the data was good and all these buybacks and all this excitement. We run into a more restrictive monetary policy, and equities continue to rally, which is totally against the school book, really.
I think on that note, quickly, Beat, on that note, FDI was still quite low on Chicago. So the Fed funds would I just see as a small element in that picture today, because at the time we were, I think the Chicago Financial Conditions Index was at 50-year lows. It still kind of is.
That's exactly the point we made offline.
Yeah.
The market, for its own, let's say, not so good, has become so short-minded. Because reality is, every financial professional that has been around for 30, 40 years knows exactly the cycle. Easing cycle versus hiking cycle, right? What we've done now, and you're absolutely right, that's why we continue to rally. But it was just a question of, okay, is it going to show up in 2 months' time, 3 months' time, 4 months' time? But we know it's going to show up. Okay, you can ride the wave a little bit, but then you shouldn't be surprised when the Dow suddenly comes off 3,000-4,000 points, because it happened, So what I mean was I grew up in a time when the market was actually the precursor of things. If we expected, okay, tightening this year, markets would already start to move that way, blah, 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 blah. Everything is sort of half bad. Now it seems the market, and it's the same as I had to adjust with my trading on news or events or whatever. For me to kind of go like, oh, I'm expecting this, I'm going to sell. These days you just have to wait until it happens. You don't gain from being too early. While 20 years ago, 10 years ago, if you smelled the story and you started to put trades on the back of that story, you would make some good money. Now you have to actually stay with the herd, and last minute you jump, right? And that's not easy. And that is our challenge of how trading has changed. That even though they go like, what, this is completely wrong, it hasn't paid out to be too early on some of those stories. So that's where I change my tactic and go like, what, I feel the market is wrong, but because the market moves up, it's no point in barking on that tree until we start to see the turn. In my opinion, we've seen that turn now. And even though that more people talking bearish on equities, and I usually don't like that because I feel we were pretty early there a few weeks ago. I stay with it. I think, whether we rally another 1,000 points on the Dow here, yeah, possible. But I think the bigger moves are still on the downside. So, and the same for Europe. And I can't make any, we could get the bigger risk off in Europe because of Brexit. We could get the less one because from a market pricing, we still expect more from the Fed. So if the Fed ends up doing less, maybe that helps, let's say, that helps that the euro doesn't completely fall off the cliff, and the dollar might get weaker at some point late in the year, balancing things out a little bit. So I think the key for us is this is going to go into sort of blocks of different stories that we again have to juggle and decide when we want to deploy which story. There's no point in buying euros probably in January while we might have a no deal Brexit. Maybe in February, when that's solved, maybe the dollar starts to weaken against the euro as well. But as we both fancied the euro higher, maybe in December, it got almost to 115, but it didn't quite do this extra 116, 117 that I saw as a chance. But now with the UK cabinet coming back on January 2, and the parliament coming back January 7 in the UK, I can't buy euro anymore early in the year. I just leave that. If it rallies, fine, I might actually sell it. But I only have one trade, like I said a week ago, short dollar yen and trying to get short cross yen. I don't touch euro dollar, or let's say I touch it tactically, more on a hit and run basis. I don't touch cable. So I think the expression of view or how many trades you can put on early year is very limited, I feel.
Yeah, that's fantastic. Before we leave this topic, before we go into the second one about bonds, I just want to leave you. I think we are around the QE mark for Europe is 1.8 trillion. I always thought it was they had about 2 trillion available, but interesting to see that whole big fat punch bowl being taken away and how that's done, because QT is it's been bumpy US, but let's see what happens with Europe, and we'll see how it plays out.
We're definitely gonna have bigger problem when you think about the sort of support that the Italian bond lose, right?
Absolutely. So the next story, which I think has got a lot of legs that could be the ongoing narrative, which is a kind of side story. It's a bond story, and there are lots of people out there saying it's going to be the year of the bonds, in particular the 10-year in the US. Now, I caught a Bloomberg piece saying that PIMCO is piling into the bonds, and I posted something which has an incorrect link, but it's a UBS guy, Briscoe, I think his name is, and he was just talking about bonds being really attractive. There is more talk of risk parity models getting back on. Obviously February turned over a few people on risk parity. But I want to just keep it really simple. I'm a tech guy. You like your techs. I want to talk about the technical picture for the 10-year yield. So this is in my simple brain. This is what I think, right? 3.25 capped, massive level, capped, right? 10-year. It couldn't stay above 3% for any decent amount of time. 2.8 broke, massive level. Next target 2.6. This calls failure to me. This smells. I mean, it's taken its time, but that's what happens. But this all smells like a failure to me on the technical description. All of this is very attractive to buying US bonds on the 10-year. What do you reckon, B?
Yeah, to be honest, while you were talking, I just looked at quickly a very naive chart here, just in a yield chart, and I sort of see that in, when was it, March 18, we sort of stood at like 274, which was more or less never be seen again when we moved up to 3.25, so we're below there, just shy. And then we have an old double top coming from December 16, and then again in February 17 at 260. So that seems to be just as a naive sort of watch where so it looks like 260 to 275 seems to be this very huge area which is covering probably about 2 years of price. And if I was reading last week and the week before, there was quite some aggressive shifts going on out of equities into bonds. So I would say only in the last probably 2 weeks is when the bond market started to be scared when equity sold off. Before, the old correlation, stocks down, bonds up, didn't really work that well. And suddenly bonds started to rally, even when the Dow was only selling off 100. So you could feel how, before, let's say a few weeks back, the Dow could sell off 300 points, and then maybe bonds would start to move a little bit. And now it suddenly starts to move as soon as the Dow starts to go into the red. So the whole dynamic has changed, and it seems that people actually, for the first time, I feel that a little bit of a fear factor is coming in. And with my view about the Fed, I definitely have to support that idea that bonds could actually have a good year. To be honest, let's say, I don't want to forecast a whole year, but the way things play out in my head, I would say Q1 and Q2 definitely, because there's a lot of that stuff we talked about may actually be hitting in Q1 and Q2, and then we see whether they get worse or if it's just ends in a storm in a teacup, or if it's actually really as ugly as I personally feel it could be.
Yeah, I mean, it certainly, if you're looking at, it risk off, I mean, that supports buying bonds if risk parity models are back on track. Obviously, February turned over a lot of guys when the vol complex blew out, as you know. If there's now a nice firm and consistent negative correlation with equities and bonds, then that's fantastic for bond bulls. The fact that Gundlach and Bill Gross said the bull market is over, when we broke these levels at 3% on the 10-year, I think it was around 3 points something on the 30-year, and these are huge levels. Made complete sense at the time, but we failed those levels. I mean, technically we have failed them. So this means people scrambling around covering their positions, or a complete shift, which is going to be the story of Q1, Q2, maybe more. The only thing I will say on that is I think it's too early right now, just for me as a person. It's a personal preference. I'm not saying the evidence isn't there, but I just like to wait a little bit longer, just because of the markets at the moment, as you said before, the herd, because they can quite quickly fail again on the other side. So the key level for me on
no, we shouldn't go gung ho, right? You're absolutely right. We had the craziest volatility in equities ever in this period. I think the drop on the 24th of December, Christmas Eve, was the biggest we've seen in the Dow on Christmas Eve. The volume was the biggest we ever seen for that time period as well. We had a shocking 5% move on Christmas Day in the Nikkei. I don't know my history there, whether that has ever happened. 24th, 25th used to be days where, it's quiet, no one is doing anything. So that shows the heightened alert the market has. But it's very hard to really, sort of overreact to the price action in this time period. I still think I sell every rally in dollar yen. I would pray we go back to 11.5 or something.
No, it's going to go back to 111.95.
Okay, that's why you want to sell.
And then we're going to sell everything, and then we're going to make loads of money.
To be honest, I'm still very tiny short, because I didn't get myself buy everything back, because I was just too nervous that stuff. I'm already nervous enough that that I squared up all my Aussie yens and Euro yen in December because of the market, and I have a few regrets there and try to get back in. But I think a lot depends now on, should stocks rally in first week of January? I want to be able to sell the rally, so that's why there's no point, banging in low ones down here. But what I always have as a trader, if I have big views, you got to have a plan B. What do you do if it doesn't rally? So I use
Oh, Beat, I think you are stuck. I'm going to hold on and probably take over. I think the key thing what we're discussing here, Beat, hopefully you'll come back with us, is, sell those rallies. But I think if it doesn't rally, what I'm going to do is probably sell tiny amounts at market, or sell really, really smalls. And I think that's certainly a case for me. But I'm still hoping that you'll be back with us, Beat. I don't know if it's my Wi-Fi seems to be fine. But I'm going to move on to JP blinking. Okay, so we both know, well, we both believe that there is no power put, there is no Fed put. And I've just been looking at some of the some of the stories going around about the plunge protection team. I've just been looking at some of the just some of the kind of stories going around about, was it a dovish pivot, about when he talked about the neutral comment and this sort of stuff. I just think he was kind of holding the market's hand a bit and being pragmatic, and I don't think I think the band for neutral is 2.5% to 3.5%. I don't think that's really changed. But yeah, I don't see JPAL blinking. But sometimes when I think that's a good sign, by the way, because you'll be back soon, hopefully. So sometimes when I see the markets or the press talk about the FOMC blinking or the FOMC doing something, I see that. I always take note. I always take note of that. B, is that you?
Yeah, that is indeed me.
Welcome back.
I guess my Wi-Fi just felt like I'm talking absolute rubbish and decided to cut me out.
We missed you. Our viewing figures dropped significantly when you left.
From 2 to 1.
So saved us now from 3 to 2 people. I'm glad you're back, mate. I was trying my best to hold the fort, but I was failing. I was like a boxer on the ropes.
Do you have your camera on? I can't see you. Do you see me?
Yeah, I see you now.
Okay.
Can you see me?
Nope.
Yeah, well, we are recording, and I am
Perfect.
I am on camera. So I was just saying that before. We obviously, bonds could look like they're going to be rallying. So we'll just see how that plays out in Q1 and Q2. Now, the third topic is JPAL blinking. We, after the neutral comment, I'm just explaining to the viewers before when you were away that, this is not really him blinking. Pausing around neutral is, I think, if there's a direct mention to pausing indefinitely, you will get a reaction, but only the first time. And I just feel, I don't know if you've heard about the plunge protection team, but this is not something that is anyone admits to, but it's something that's around. It's something that Bloomberg pick up on. It's something that Reuters pick up on. The guy, yeah, I mean, this kind of thing. And about the Fed blinking or the put, okay, if I strongly believe there's no put and you do too, that's absolutely great. But if Bloomberg and the press keep going on about this, then that's going to affect the market. So it's just something to be aware of. That's all I'm saying.
Yeah, I agree.
But so the final thing is still selling dollar, but a risk-off move will be brutal. So I'm privileged to get a few amazing tier one reports, and some of the business cycles I've been looking at, and at the end of a cycle, at the end of a kind of or around the recession, at the end of the growth or around recession, you get a risk-off dollar move up.
Yeah.
That is quick, it's brutal, it's nasty, and with the global issues, and certainly Jay Powell mentioned this as well, and we were talking about this as well. This could happen. So if that doesn't happen, I quite like selling dollar at the moment just because of the OIS pre-pricing and the fact that we're not really going anywhere in the economy at the moment. We're still at the highs. And also the other thing is CPI is going to get absolutely nuked because WTI is around 40 bucks. And if it stays around there, shale producers in the US are going to really feel it as well. And because they've got higher break-even costs, I think I heard.
Yeah.
And that hasn't been reflected in inflation, and it really hasn't. So the longer it's around this level, then the lower inflation is going to be. My eyes are on core because core's around 2%, headline's not far above.
Well, to be honest, that's exactly why my plan is the only dollar short is dollar yen, because I don't think there's any other dollar you can sell. But that's why, and if you look at dollar Canada, it's probably a very interesting dollar to look at. The market has tried to pick a top in that one, and I was sending out the blog about the Canada yen, right? So that one is probably Aussie and Canada is probably the easiest ones to see what's actually happening. There was only one move in the last 2 weeks, which was a yen cross move. And it took dollar yen down, it took the risk of dollars up, and that's why I keep on banging on with you and with my students or on when I'm blogging about crosses. If you understand the dynamic, you actually totally utterly understand why there's no point fading an Aussie dip, there's no point fading a dollar Canada rally as long as this dynamic is running. The only thing we can say, the crosses have moved a tremendous amount as we just see on your chart here. Aussie yen, Canada yen looks exactly the same. It just has absolutely mental. And the market that is only dollar focused, and that's where we have to be careful. I'm not a dollar bear. I'm a dollar yen bear. And I think the other dollars, they will turn at some later stage, but from complete different areas. I think Aussie is still at risk to see 68 or lower. I wouldn't be surprised if dollar Canada goes to 138, 140. So don't sell any of these other dollars. I don't think, I think this cross dynamic, which I still hope we're going to get a rally in the first 2 or 3 weeks of January, to get better levels to sell Canada yen, Aussie yen, or Euro yen. For example, I could see the Euro yen, and that Euro yen will probably be the first yen cross I'm going to be selling. If we get this negative Brexit news and we stay on a risk-off path with US equities that keeps dollar yen under pressure, I could see Euro yen just absolutely finally rolling over and probably hit 120 or lower. Okay, step for step, probably first we have to hit those 125s and a halves again, 124s and a halves. But if you look at your chart here versus the April lows there, Euro yen is still relatively high. If you were to talk about a proper risk off, right? So there's another room. My target in dollar yen that I was blogging about is 100. Obviously not in January, but I think dollar yen could reach 100 in the next sort of few months, and Euro yen will be on a different. It's going to be probably somewhere, I don't know, 115 or something like that. So I have very strong views on FX, but it's going to be one after another. So you sell your dollar yen, you try to pick a level in the crosses, and at a later stage, maybe the dollar turns, whatever. That's too early to think about. We have so many stories in Q1 to follow. It's probably not even a point to get too ahead of the curve here with all these things. But keep an eye on dollar yen. If that one starts to slip, That's why I say you need a plan B.
Yeah.
It would be claimed to be bearish, and suddenly it's 105, and you go, oh, never been short. Can we see 111.5 again? Definitely. Could we see 112 if you get like a 2 weeks of a Dow rally in January? Yeah, possibly. I pray for it. I wouldn't mind one, right? Because I need one.
Yeah, that'd be nice.
But the ideal sell area in dollar yen is 112.20 to 50. The problem is ideal sell levels. If the trend is right, you usually don't see them again. So that's the only thing I add here. So you probably have to lag into that stuff on a 111 handle already, I think.
Yeah.
Just not to miss it. But other than that, I don't have very strong FX views for early 2019, mainly because we go back to the political driven effects with Brexit in the first few weeks of January. That's going to be havoc again, I guess.
Fantastic. Well, Beat, it's been a great session as always. The only thing I'll say is just tomorrow's going to be. It's not going to be as thin as Christmas, but it's not. I just pick your spots. Just watch your risk, and you've got a whole new year, 2019. There's going to be loads of opportunities. We'll be in touch. We'll be with you step by step. So just have a good one. And before we go, I just want to tell you about the amazing commentary and trade ideas and levels that Beat does. He works tirelessly. Sometimes you get 30, 40 emails every day. It's amazing, actually. It's been a real help for me personally, and I know that you've got some amazing students from retail, but also institutional guys, and they all really value your work. Maybe you'd like to tell us a bit more.
Yeah, thanks a lot, Patrick, for the compliment. Yeah, so what I do is I'm doing the sort of core currencies in a 4-hourly daily chart. So something in there for day traders, something in for the macro traders. I give my sort of spin to it, my ideas, my thinking, the stories I'm looking at, just to kind of break macro down into a tradable trade. Next to that, I write my own research at times when I just sort of try to link the stories and present them in a more, risk taker view rather than just a non-committing economist view. And as Patrick just said, it's kind of red from retail. Institutions are liking it a lot. Patrick likes it a lot, which I appreciate. And whenever you're interested, get in touch with me directly or with Patrick, and I can tell you a little bit more about it. Thanks a lot, Patrick.
That's great. Well, we're sadly it's the end of the show, but thank you very much. And thanks, Beat. A really big thanks, and for your insights as ever. It's been fantastic. And we'll talk tomorrow, obviously. But have a good New Year, and watch these crazy parties.
So celebrate, go out there, celebrate, and 2018 behind us, and we're going to have a cracking 2019, I'm sure.
I'm sure. Take care, Beat.
Take care.
Thanks very much. Bye now.